Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome to another week, another episode and another really interesting development in financial markets, particularly here in Kiwi. We had the Reserve Bank's monetary policy statement, which had a little bit for all of us, had a little bit for those expecting more cuts and a little bit for those expecting not as many and plenty in the middle. There was a lot to decipher. If you read the statement I think was dovish or bearish, not butterflyish. And there was a lot in between, but then if you watched the press conference and took into account that they had a vote, that was a bit strange. So we're going to go through that and our outlook, which we're frantically updating. So Sabrina, I'll throw to you. What did the statement show? What are their forecasts?
Okay, well, to throw in another animal, I'd say that the statement itself and all the accompanying forecasts, they were pretty dovish. So I guess we should start with, the most important, forecast, and that's the OCR track. Yeah. That was lowered. So we went from a low and a sort of flatlined 310 OCR track that was pulled lower to a 285 bottom, which, as you say, it signals more cuts. We've got another 25 basis point cut to 3%, basically fully baked into the cake now. And then from there onwards, there's about a 60% chance of whether they go that further step to 275. Again, we still think that, give them some time. They might see that they're undershooting it, might actually need to go to 2.5. Our call hasn't changed. So that's dovish in itself. They've signaled that the Kiwi economy needs more relief. Behind that is, weaker revisions to the growth outlook. So all of this stemming from, the uncertainty, the trade tariffs, just a weaker global growth outlook. I believe the Reserve Bank are expecting a sort of 0.5 percentage point shaving to our trading partner growth. And that sees Kiwi growth, I think, we're slowing from previously they've had forecasted us to average, I think, 1% growth over this year. Mm-hmm. That's now down to 0.7%. So you're getting really low growth. Unemployment is, higher for a bit longer as such. So looking at all of that, you'd say, yeah, this is a central bank that is looking to deliver more, to do more. You'd expect, wholesale interest rates to pick up on that and sort of maybe drop further downwards. Mm. But then, as you say, you had the press conference afterwards, which is kind of the opposite, right, MJ?
Yeah, it is. And actually, just before we talk about the press conference, another key forecast that they showed the big downgrade to was their inflation forecast. They have it penciled. I think they've got penciled in that inflation falls to below 2%, like around 1.9 early next year. Again, their medium term outlook for inflation has softened from what they thought, a couple months ago.
So on paper, we had, a downward revision to growth to really anemic levels, like what was it, 0.3 average over the next 3 quarters. Yeah. That's really weak. Yeah. And you got a lowering in your inflation outlook and a lowering in your OCR track by 25 basis points. That was kind of what we were expecting, but then things changed in the press conference.
It did. That press conference, there were some comments that were made by the governor and chief economist Paul Conway as well, just around just being a little bit more hawkish or less dovish than we expected. One of them that kind of lifted my ears was when he said that they have no bias going into the next meeting. Like the track shows that they've got another 2 rate cuts from here, signaling another 2 rate cuts from here. But they said going into July they'll have no bias going into that meeting. But things like that. Things like saying that the cash rate is close or is in the neutral zone, which kind of, markets took as we're nearing the end of the cycle, that this is the time for them to stop. That was kind of hawkish, as well as I think the biggest surprise really was that they went to a vote this time. They voted 5-1, one dissented, opting to keep the cash rate on hold and just kind of assess the situation. We always knew that uncertainty would be the big word. We've heard it from all the other central banks, but really this was, a meeting that was clouded in uncertainty.
Was it really mentioned 150 odd times, the word uncertainty?
164 times.
Yeah.
That's a lot of times to put the word uncertain.
Just to, give you an idea, that's almost 3 times a page.
Yeah.
Yeah.
I mean, they did dedicate a whole chapter to uncertainty, because that was the other surprise this time around, was that they did scenarios, or they presented alternative scenarios on the economy, which is something they hadn't done in 5 years as well. So last time was during COVID.
Yeah, I think it's worth talking through the scenarios, because we have been asking them to do scenarios on a more regular basis, because we find them really useful. We know if the upside comes through, this is the reaction function if we see some sort of downside. And so the upside was pretty much they'd still cut, but only to 3. And that's if it's more of a supply shock globally and an inflationary shock here. Then if the downside comes through and it's a demand shock, which we tend to think this could be, then you get lower growth, lower inflation, and they cut to 2.5, which is our base case actually. So it was good that they put those in there, but I think people take what they want. I want the upside one, I want the downside one. Okay, and there was a bit of movement in markets. So what happened in markets?
Well, if you look at the currency, we were saying how that kind of reacted as you expected, whereas on the day there really wasn't much move. It's largely being driven by what's happening overseas, understandably. But then the rates market, there was this interesting sell-off in Kiwi rates. It started to trade a little bit higher on the day. I think it was like 10 basis points higher on the day? And then that kind of continued the next day. And part of it maybe because of those kind of hawkish comments made during the press conference, you kind of saw that that sell-off really start then. But then also you were saying, JK, that it's potentially some traders, taking some profit at these levels.
Yeah, I think so. So I think the currency market actually reacted as you'd expect. Like you said, it kind of looked like a heartbeat on a monitor. It sort of went up, down, and then sort of traded sideways as you would expect, because I think the statement reflects what we think. But then you had the rates market sell off 10 on the day, and I think we're up about 16 basis points from where we headed into. I think that you get hedge funds who place bets, and I know they place bets because I spoke to a couple beforehand, and they would have looked at that and gone, you know what, the risk reward of holding on to received rates, is not quite there. So we'll take money off the table. And I think that exacerbated the move higher in Kiwi rates, but they'll be back. Yeah, I think we're still on a path to 2.5, and you will get people coming in going, that 3% terminal priced in wholesale rates. There's a lot of value there in case things do go wrong, and you actually get a 50 basis point move lower. If I was a hedge fund, I'd be taking bets on that.
Yeah. So do you think the Reserve Bank will be, is this the reaction that they wanted or expected to see?
Well, maybe I overread it, but Christian Hawkesby, the governor, during that press conference was asked about the sell-off in Kiwi rates, the push higher in yield. And he turned around and said, well, our OCR track reflected market pricing before the meeting. So the OCR track goes to 285. Wholesale rates were at 285. So he would have thought, well, maybe we shouldn't get much of a reaction.
Yeah.
But we did.
We did.
Yeah. Markets always move, a lot more than
they get carried away too, though. Because I think it is really important to bring it back to the fact that, yes, you had these hawkish comments, but again, if you look back to the statement, that was all really dovish. So nothing's really ruled out yet. As much as commentators and markets have probably taken it, this is probably the end. Actually, I think if anything, the Reserve Bank statement probably just points to the fact that it's so unknown right now, and they're taking it sort of day by day, which, they always do anyways. And like you said, there's still a lot of room for things to go south from here. I mean, there's been no real resolution on the sort of tariff situation. I mean, you've got a legal battle happening at the moment, which who knows what's really happening there. It's hard being an economist because I feel like you sometimes have to be a lawyer too when these things come up. I was trying to figure out what's actually happening on whether tariffs are in or out. Yep. But even at the same time, you have China and the US re-escalating. Again, largest trading partners there, even if they're just going on their own thing, that's still problematic for us. And then you've also got the shots kind of fired to Europe and the US. Not actual shots. What did you say they were?
The proverbial shots. Same. Yeah. Yeah, uncertainty is the biggest thing here. And that was the reason that one member opted to keep cash rate on hold. So they seem to have consensus. We were talking about this before. They seem to have consensus on the path ahead, but it's just the next move is where there was a bit of a difference in view.
Yeah, and I don't mind that. So you've got one person in 6 who's turned around and said, you know what, the Fed themselves, other central banks have actually just sort of put their hands up and say we need to sort of wait and see how this plays out before we make big changes and call it. I don't mind that, but I do think that we are in a weaker world than we would have been otherwise, and that feeds through to small open traders like ourselves.
Yeah, the forecasts were undeniably weak, which is what you'd expect. Their overall conclusion of the current situation is that it will lead to a slowdown in global growth, which will be disinflationary for us. So that is the, I guess, executive summary of their new forecast.
Yeah. So for, Kiwi businesses and households who have read all these crazy headlines, what's our message?
I think you can say that the key takeaway is still that more rate relief is coming. We know there's at least that move to 275 is pretty much there, at least to 3%, which wasn't fully clear in the February MPS.
Yeah. Yeah, it's right. They said 310, right? So it wasn't. Yeah. It was like a percentage probability of going to 3. We're definitely going to 3 now.
Yeah, and even in their upside scenario, going back to the scenarios where it is more of the tariff situation evolves to being more of a supply shock and higher inflation, they still signal a cash rate of 3. They go below 293 at 293. So yeah.
So that's good. A lot of that's factored in. Probably won't see mortgage rates move a lot, but we're not seeing them rise. I think that's key. If we're right and we get a 2.5% cash rate, mortgage rates have got further to go. If we're wrong, we sort of muddle through an upside scenario. Maybe mortgage rates don't fall from here, but they're not rising. I think that's a key bit. Even if they stop at 3, they'll be on hold for, I think, an extended period just based on their own forecasts. It takes a long time for the economy to recover and for inflation to, stabilise.
Yeah.
There's also a lot of talk right now about how between now and the next time we hear from the Reserve Bank, we don't have a lot of domestic data out. I think we've got Q1 GDP, which, as we all know, is very dated in the Reserve Bank, and we don't really like that much.
Yeah.
And so there is this sort of growing, not argument, but I guess, people are talking about the fact that maybe that July rate cut isn't guaranteed and maybe it gets pushed out into August. What are our thoughts on that?
Well, I guess, in the broad scheme of things, it's not a big difference whether they're cutting in July or August. My personal preference is obviously get things done. If you go into 3, get there as soon as possible. If you go into 2.5, get there as soon as possible so that it feeds through the economy faster. This whole kind of pausing, going, just front load it, get it done. We need an economy bouncing back. That's my view.
Let me be that one dissenter and say don't move away. Was the issue was around inflation expectations and how that had recently ticked a little bit higher in the last print, and it's just one move. It's still our expectation that it's more disinflationary, the tariff impacts, but that little move was enough to have someone voice out and say, I actually don't agree with.
Which, can I say, I don't actually agree with either, because I thought okay, maybe I'm going personal take now, but I thought that lift in inflation expectations was kind of like expected. You know, you had this whole tariff situation happening, that people had this idea that maybe higher prices were going to feed through. You also had the Q1 CPI print hotter than expected, largely off the back of a weaker dollar and higher tradable inflation. So I kind of thought, you know, when we were expecting that release, I was like, yeah, there's going to be a bit of a lift in inflation expectations, so long as they're still, you know, contained within that 1 to 3% band. In fact, they're still pretty close to 2. They're about 225, 230, something like that, right?
Yeah.
Not important, but they're still, you know, still contained. I understand that you have to obviously watch it, and if it keeps accelerating, then that is a point of concern. But I thought maybe it's a bit premature from my take.
Yeah, I tend to agree. I mean, if you just draw a chart of inflation expectations, they do just follow inflation quite closely. So the best guide to the next inflation print is the last one. Unfortunately, I think it's just that there are some forecasters out there showing inflation going further in the next quarter, right? At least. So until that kind of washes out, I guess. Yeah. You're right. Inflation expectations are still, you know, reasonably anchored. They're just not as well anchored as they were. Yeah. They were pretty flat at 2. Now you've got sort of like you say 230-ish. It's just a move in the wrong direction.
Yeah. I think we're just a bit sensitive as well because we've just come off that really long inflation battle trying to get that down from 7.3 to where it is now. So we're just a little bit, you know, wary of any upward move. And as you say, non-tradables, which is domestic inflation, that's still taking quite a long time to actually ease. So it's an unhelpful move, that's for sure.
I know one of the frustrations within the Reserve Bank has been, well, not necessarily a frustration, just an awkward observance, is that non-tradables has been stronger than what the output gap suggests. So we've had a weaker economy, we've had a recession, but non-tradables has held up, and it seems to be lingering inflation from COVID. So I know that's a frustration. But then on the other side, house prices are, you know, well below their forecast of a year ago. So that sort of wealth part for the Kiwi households is softer.
Yeah. There's a lot of like offset moves on. So it's hard to get a proper gauge of the economy. It's a difficult time to forecast, that's for sure.
Do you want to use the word uncertain?
Yeah. 164 times.
Uncertain. Okay, that's me done.
But we're updating our forecasts, aren't we? So we're going to go through that same process.
Yeah. Yes.
Yeah, don't go into it now. That's an episode.
Way too much detail.
Yeah,
that's an episode 2 weeks away.
Stick around.
Stick around for what we
space.
think is actually going to happen. This is what the Reserve Bank thinks.
Well, why don't we leave it there? I mean, I reckon, did we cover everything?
Yeah, I think we did.
Yeah? Okay. Well, thanks for tuning in. I hope that was useful. We will be back with our own forecast update, if not next week, the week after, once we've crunched the numbers and gone through things. But I think we're still on the path of, you know, heightened uncertainty, slow growth, lowering inflation expectations and inflation, and lower interest rates. So watch this space. Thank you for tuning in. Please like, subscribe, follow, do what the cool kids do, and we'll speak to you again. Thank you. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.